Paul Ashworth standing by via Skype to go and answer the question markets are grappling with at this point in time. What exactly is a pivot and what's not? Welcome back to the program, Paul. Everyone's talking about it from the Federal Reserve in particular at this point in time. Do you want to go and have your say as to what exactly a pivot entails?
Sure. Well, a pivot's is a change in direction to the dictionary, and I don't think we can see a change of direction at this point in time. Scotty, I think for us, there's one key thing that's standing out. That is the US Fed needs to create unemployment. So our case is the US economy gets a recession next year. That's required. It needs it. It needs to have a recession. The reason for that is the only way we can get to a satisfactory wages growth outcome is by creating 1.5 to 2% additional unemployment. History tells us that has only been achieved by a US recession. The key thing for us that we're watching is that as the pivot point is to see an increase in unemployment. The other aspect here is obviously to see shelter and services inflation to seriously moderate. If we were to take away all the supply side goods inflation at this point in time, we'd still be left with core we'd still be left with core US CPI at 5%. And that is being driven wholly and solely by shelter and services inflation. So the driver of that, as you can see in the graph there, is wages growth. And as I said, to get that wages growth to moderate back down to a 3.5% level, is we need to create that level of unemployment. So the pivot point is to see the unemployment level increase.
Okay, now to go and do that, there's a number of different ways. You can go and have people get laid off, or you can also try and attract workers back to the labour force. Now, unlike what we're seeing here locally, of course, in the United States, participation rates remain way below the levels they were prior to the pandemic. What do you think explains that? And is there any way that you can see that reversing anytime soon?
I think it's really tough, Scotty. We go back to the Trump administration. We saw the defunding of the US immigration services. They're running at 800 to 1 million people less per annum than what they previously were. So that's I suppose that's number one. Number two is we don't think their COVID labour policy worked. We made quite a lot of mistakes here, particularly in terms of throwing too much money at it. But we got one fundamental thing right. That is, we kept the employee connected to the employer. In the US, they didn't do that. For the employee to get a benefit, they had to be sacked. So they could actually go to Social Security to get the benefits. So, we've seen that disconnect. And the third element is, the over 55 age group of the labour force that had actually been leaving, the labour force, pre-COVID. Though I will say we have seen the worm slightly turn in terms of that over 55 segment, and there is some early signs that they are returning to the workforce. But there are key structural problems there, and that's why the US is going to have to work a whole lot harder, and it's why it's a whole lot different to to Australia policy settings to really get that level of wages growth down for a structural labour market that's had a lot of difficulties really for the last 6 years.
How close do you think the Fed is to being able to go and crack the labour market? Of course, we sympathise with workers who go and lose their jobs. Let's not go and beat around the bush there. But it was a more broadly a macro perspective. How close do you think they are to that point? We're hearing lots of talk about tech layoffs at the moment, but is that really indicative of what we're seeing across the broader economy at this point in time?
Certainly. We're seeing that anecdotal evidence in the big end of town, not just in terms of the tech companies. We saw Walmart last week, announcing some serious layoffs. We do think it's slower in the US, and it's slower because when they're tightening policy. The impact is more marginal, particularly on the household. That therefore heightens the risk that they over tighten. That's what history tells us in terms of Federal Reserve actions. To actually see those signs, they tighten. They over tighten. And I think it is, as you pointed out, it's complicated or overcomplicated because the US labour market is structurally not in a good place, as a result of immigration, over 55s, and that COVID dislocation in terms of the employee and their employer.
So the Fed's going to try and induce a slowdown to go and weaken demand and bring demand and supply back into equilibrium, and that should go and see inflationary forces start to go moderate, at least in theory. From an investment perspective, Paul, it's a pretty tricky environment to go and find the right place to be, given this pretty precarious point of the cycle. When you're looking forward to next year, where are you starting to go and position portfolios at this point in time?
So to that, I said the Fed will go probably too hard. I think likewise the Reserve Bank is not going to give away its inflation fighting mantle that it's got to over the last 30 odd years. So I think that actually does provide an environment particularly through the second half of 2023, where we would say that monetary policy does succeed to significantly moderate core inflation. So with that, we actually think that bonds and treasuries should do well. And we've seen let's say in terms of the 5 and 10 year curves, the market's starting to see. We do think central banks will achieve their goal. It'll be painful for the real economy. It'll be painful for households. So we see good value in longer term, high quality duration bonds. Particularly in the AA, AAA rated sphere there. Trading let's add 130 to 150 over spread. We also think that we're in a world where there is another pivot, a fiscal pivot, in terms of energy transition. We do see that inflation, and interest rates, as they lower, they will still lower to a higher level than what they were previously. We think that's good for capital investment. We think that's good for well conducted, quite reasonably priced industrial businesses, particularly in the US. There are some really high quality industrial businesses there that are worth accumulating in over the course of the next 6 months. So they're really the two key things for us. And you actually get you are getting paid quite well, for high quality risk in bonds, quality bonds, and there are quality industrial businesses, that will go well over the course of the next 5 years, as a result of the the transitions that are occurring, the additional fiscal stimulus that's occurring, the energy transitions that are occurring. So we do think there's good value in those two asset classes and those particular emphases.
Paul, you've been very generous with your time. I'm going to try and squeeze one last question in, if I may. Just giving your views about the longer duration, high quality debt out there at the moment that you like the look of. What about those long duration names in the equity market universe? I talk specifically about some of those tech titans in the United States that were in vogue for such a long period of time. At what point do you start to translate your views towards the bond market and start getting a bit bullish as well when it comes to those longer duration plays?
Sorry, Scotty, the longer duration plays in equities?
That's correct.
Yeah. Our preference, Scotty, and it really goes more to quality, is to what extent they really do represent the smart technology, or at the end of the day, are they just B2C operators? We certainly start to see value in terms of Microsoft. We see value in businesses like Oracle on a B2B basis. So we think they're interesting tech-enabled businesses. But look, I have to say, we're very much focused on a risk-reward basis. In terms of the duration that we're seeing, we like, as I said, we like the duration in terms of bonds, which are paying us anywhere between 5 and 6%, as I said, 130 to 150 basis over swap. We expect those bonds to come in close to 3.5% over the course of the next 18 months. We also like duration in terms of high quality warehouse and logistics assets, particularly publicly listed assets. We think publicly listed, publicly traded property assets, both here and in the US, in warehouse and logistics, represent fantastic value. And again, on a risk-reward basis, we think the transition and just the change in leadership from monetary policy to fiscal policy, together with the energy transition, says that again, you're going to get better risk-reward, in terms of high-quality industrial businesses, rather than those tech B2C businesses.